Hi everyone. So now we are in the last portion of the course, and the course Introduction to Commercial Banking and Fintech gives you the idea about how the overall commercial banking looks like. And we have covered almost all the aspects, but toward the end I wanted to touch upon one of the important dimensions. And why I am saying it toward the end, because we are going to finish the banking structure part, and then after this we will start with the fintech setup, that how fintech looks like, and then we will have the further understanding about the different dimensions of the fintech. Over the years, climate change has become one of the important topics to be discussed, and we have seen that there are different norms for climate disclosures across globe, and companies across the globe are structured or even directed to come out with some disclosures. In that direction, the banking sector is also not immune, and banking sector is also supposed to bring certain regulations to check so that climate risk does not impact the banking sector significantly. So I thought it will be good that I have at least 2 to 3 lectures on climate risk and the banking system. So idea is that when we discuss the climate change, how it is going to impact the banking sector, we have covered almost all the technical aspects. So I thought that this will be a good addition. Some of you may be interested in pursuing a climate finance and sustainability related courses in future, and if you are planning, then this particular lecture will be very helpful. And towards the end, I have also given some of the good references, and wherein you can also check and read. But these are new things, some of you may not be aware, but it will be good that if you can focus on this area, because these are the emerging areas in the banking sector regulation, and there is a lot of scope for job creation and further development. So here it is, why climate risk matter for banks. Because if you think about the climate change, so climate change is basically a set of indicators, governance indicators, that each and every bank or each and every firms have to declare. It also talks about that whether the borrowings done by firms from the banks, if it is getting into the climate related activities, then what is the return, and if there are risks involved, then how it can be done. So here you can think about, we have done this part already, that banks are exposed directly to the corporate loans, retail mortgages, MSME, micro, small, medium enterprises, investment portfolios, both equities and bonds are important. So banks do not face climate risk directly from weather events, they face it through borrower performance deterioration. So here it is, climate risk. So climate risk is equivalent to what we have the credit risk, right? So credit risk in the sense that if we are going to see a natural hazard occurring, and I will be discussing that in a few moments, that how it is linked. So if we have increase in, I would say, climate risk, then this will further has the impact on the borrowing and lending by banks, and this leads to what we call it as the credit risk. Now apart from this, the idea behind this is that how we can touch upon the risk transmission process. So here is a transmission channel. First we see that there is a climate shock, so maybe the rise in temperature, maybe the rise in some other angles that we say. We divide the climate shocks in 2 ways. One is the physical risk, another is the transition risk. What is the physical risk? Physical risk could be in terms of flood, drought, heat waves, damage of others. For example, if the plant is located on the shore, and mostly you can say seashore, and if you have high tides coming, and that could be because of the earthquake or something in the sea, it impacts the whole plant area. As a result, if you have the production failures, then this may further, and if you have borrowed money already from the bank, then you may not be able to pay on time, and this increases the risk for the bank, right? So that we have discussed already in the form of twin balance sheet crisis. Then here we have the transition risk. What is the transition risk? So the risk, because it is not a natural, so it is like humans undertaking measures for climate change adaptation or mitigation, so that those activities are included. So one is called carbon taxes, regulations, technology shift, and how it impacts the others. Core power plant, so I have given you an example. So let me first get back to what I am trying to say here. So here we have the first climate shock, that it increases the finance firm losses that I mentioned about the plant. This will lead to increase in probability of default. This we have already discussed in detail. Probability of default. Then here we have a loss given default, right? So probability of default, loss given default, and then it leads to finally if there is increase in probability default, like for example earlier the probability default for the firm through the Basel II norms, we know the probability default, the internal rating based approach IRB. So 0.3 if it was, and because of the climate shock, if it has gone to 0.8, then certainly there is an impact on the loss given default. So bank rate losses, there are impact on the banking sector activities. Here there is a small example here. For example, a coal power plant financed at rupees 5,000 crore, carbon tax, suppose the government imposes under transition risk, government imposes the carbon tax and it reduces the net income, which is the EBITDA, a good proxy, by 30%. And as a result, once the net income comes down, the EBITDA, earning before interest, tax, dividend and the amortization, so debt service coverage ratio falls below 1, which means that the firm is not even to pay the rate of interest of even 1%. So you can think about the risk. If the bank is charging 10%, then the overall risk will be increasing, right? So default risk increase. So what is the expected loss? So expected loss, how do you calculate in under Basel II? Now you are aware. So it is probability default multiplied by the loss given default multiplied by the exposure at default. That what is the exposure? So this is what we try and look into this. Then from the balance sheet side, I think these things we know already, that there will be rising non-performing assets if we are going to see the climate risk. There will be impact from the balance sheet side in terms of provisioning requirement. If the banks are seeing high rise in default due to climate change, then there will be of course the higher provisioning requirement banks will have to keep. So that comes under tier 2 capital, right? So tier 2 capital will increase. As a result, this will create further trouble. Then the capital erosion, CET, that we know how critical it is. This is the safest capital for the bank. So in case of insolvency, the CET is deployed first, then AT, then we go for tier 2, right? So declining in capital adequacy ratio coverage, leverage ratio, and all those confidential and I would say the performance indicators will have the difficulty, and as a result bank may have to face the bankruptcy. Climate risk affects both in terms of credit risk, higher probability default and loss given default. Market risk, there will be a lot of impact on the bond issued by the bank, by the firms, if the firms are going to default, and if the banks are already holding those bonds, then banks will incur huge losses. So this could be one of the reasons, right? So ultimately climate shock, this leads to borrower loss. Ultimately here we have the higher expected loss, and this leads to what we have the capital erosion. So this is where it is very, very important. Let's have one numerical understanding about the transition risk shock. So here your loan exposure to carbon intensive sector, so rupees 20,000 crore here we have. The initial probability default is 4%. Post regulation PD, suppose after carbon tax, the probability default of the firm increases to 8%. Assume that the loss given default is 15%, right? Given that how much is the exposure, right? So loss given default, that how much the bank can recover through collateral and others. So change in expected loss will be how much? 0.08, 8% minus 0.04. So 0.04 that we are getting here, right? This is a loss given default is 0.50. The exposure is 20,000 crore. So you can think about that it will be having 400 crore. Now, if the bank is going to experience 400 crore of loss, then from where it can recover? So suppose luckily the bank is having the CET, the common tier 1 capital of 10,000 crore. So bank can easily absorb 400 crore from this tier 1. Had it been that the bank is having the CET1 that we will see later, most probably the CET1, if suppose bank is having only 300 crore, right? And then additional a capital, tier 1 capital that here we have. A bank is having 100 crore, right? Now you can see bank is first it will deploy 300 crore to recover the loss or manage the loss, and then again 100 crore rupees to manage. So it means that bank does not have any thing now. It means that bank will have to make money and having some kind of income earning instruments. But in this case the shock absorption is not that high, and we will deduct 400 from 10,000, so it becomes 9600 crore. So CET after climate shock, you can see that the core capital of the bank is declining, and this may further create trouble if there are no proper safeguards in the economy. So capital ratio declines. This is what we see, potentially triggering supervision concern. If we are, as I saw that here we have 400 crore and 400 crore is the loss, then in this case central bank will have to intervene. Otherwise it may be a case of a proper bank run, right? So these are the climate related shocks and how those shocks are penetrating into the banking system. So this is important to understand. Now suppose the bank is having the mortgage exposure in flood prone region. The bank is operating in an area where you have a flood incident occurring every year, and if the exposure is into mortgage sector in terms of housing and others, then this will further to create trouble. So here we have 15,000 crore. So this is what we have. So so severe flood event causes probability default increases from 2 to 5%. Loss given default rises from 30% to 50%. Probability value decline because if it is in flood, then of course the value of the house or any real in a fixed asset will decline, right, if it is underwater. So this is the reason that initial expected loss is 0.02 into 0.30 into 15,000 is the exposure. So it comes out to be 90 crore only. Now post shock it has gone to 5% and 50%. So 5%, 0.05 and 50%. So here it is coming out to be 375. How much we are seeing increase in losses due to flood prone? It is coming out to be 375 minus 90. It is coming out to be 285 crore. And this is where it becomes really important, that how do we deal with it, right? So this is how it becomes important here. Now another aspect related to this is how the climate, both fiscal and transition, directly affect the bank balance sheet. So this we have already seen and you will find that it depends upon the sectoral concentration risk, pro-cyclical capital stress. So these things will be required. If the central bank in India, RBI, is already trying to bring out new norms for capturing such type of shock and defining them, because there is going to be a systemic kind of shock. It could be also pro-cyclical kind of shock that could further create the impact on the macroeconomy. So all these things are linked with the macroeconomic setup. So this is where it is important. So I have further categorized the fiscal risk into two, so acute and chronic. So acute could be the flood damaging collateral. So this is what here we have. Chronic could be like a sea level rising and real estate decline in the real estate value, persistent drought affecting rural credit portfolio. So all these things are linked, and this leads to increase in PD and LGD. Transition risk are all this that we have. Financing risk arising from the shift to a low carbon economy. This also leads to what we have, the carbon taxes, increasing operating cost, fossil fuel, phasing out regulations. All these things are linked. So EV, for example, electric vehicle, if the government, suppose there is a state transport corporation which is already under loss, and government puts a very strong regulation that all the state transport corporations have to deploy 60% of their fleet into EV vehicles. Now these state corporations will have to go and borrow the money from the bank, and if the state is saying that no, we will not give you any initial support, maybe the 50% support we will give of the all fleet, but 50% you will have to manage. Now these state corporations will go to the banks will charge higher rate of interest because they are already into losses and their utilities. So if the state transport corporation does not pay on time, and if it creates extra burden on the state corporation, then it may further aggravate the problem, and this may lead to the failure of the bank. So this is how we often deal with the banking risk. So banking implications of profitability declines, and then there will be further the credit downgrades, and this further leads to what we have, the capital stress. So basically both physical and transition risk impact the credit and also the operational channels of the banks that we often see. So for example, physical risk transmission to banks. So here we have bank loan exposure is 500, pre-flood is 3%, post-flood we have 15%. Now we have seen in the last example also that expected loss that we are seeing because of the probability default increase, and given the loss given default, it is going to increase by 36 crore, and this is a very challenging scenario for most of the bank, and you can see that how it transmits. So now let's see the example at the household level. For example, if the household, if a bank has the exposure at the household level, in case of a mortgage, it is 1000 crore, probability default rises from 2 to 6%, right? The loss given default rises to 40%, right? Because bank is not able to recover because it is a flood prone area and bank is exposed to household. So then we can calculate that the cost will be around 16 crore. If the bank does not have 16 crore rupees as a CET1, then it will be very difficult for the bank to survive. So this we have higher NPAs, provisioning, and CET1 erosion. So this is what we find. The another important dimension is the standard asset risk, which means that those assets which lose permanently economic value due to climate policy, technological shift, and market transitions. So for example, we are seeing that everywhere after the climate change concern, the coal mining activities are getting reduced, but this can also create a lot of impact, right? So coal mines under phase out regulation, thermal power plant displaced by the renewables, oil gas reserves becoming non-viable. So all those angles we look at. So policy shock is equal to a firm cash flow decline, higher PD, LGD, and bank losses. So it means that exposure is equal to, suppose for example, if we want to try, suppose exposure of total exposure is 5000 crore, the probability default is 8%. The loss given default rises from 40% to 65%. So your change in expected loss will be 0.08 into 0.65 minus 0.40 into 5000. So it will be around 100 crore, and this is where it is very, very important to note, right? So this is what. So banking implications of a standard asset risk is immediate balance sheet effects, that how it leads to. So I think these things we have covered up already. So this is for your reference, right? So it first leads to higher provisioning, then CET1 requires a special attention, then your capital adequacy ratio will change, and if you have exposure in mortgage and others, so your risk weighted asset will also change, and overall common equity tier 1 capital ratio will also change, and this will further impact the already listed firms or banks, and that will further deteriorate the overall functioning of the bank, and this will have further implications on the economy and other dimensions, right? So this is what here we are. Another important dimension that we often touch upon is that over the year there has been some kind of regulatory change happening across globe, and firms and banks are requested to declare certain climate related indicators, that how much energy they consume, how much emission they do, what is their labor and other requirements. So there is something called ESG, right? Environment, social, and governance, right? So ESG we are doing. So it refers to information that is significant enough to influence the decisions of the investors, regulators, and stakeholders, right? And regulations are normally, so materiality is something that, so suppose a firm declares 100 indicators. Out of that, suppose you are a stock market analyst and your exposure is in the company's stock. So you want to see that whether those factors which you want, whether it is included in the 100 indicators or not. If it is not included, then there are materiality issues, which means that information for you which is financial material, it includes like earnings and profitability, the tier 1 and the regulatory indicators, the capital adequacy ratio, market valuation becomes, and risk profile and solvency, that whether the bank will remain solvent or there will be impact on the solvency part. So rising NPA in the infrastructure sector that we saw from 2015 to 18, reduced bank capital, interest rate hike that further will have impact on the portfolio and others, which means that the climate risk, as you can see, it has the potential to come under the direct impact of the regulation. Now there is one more angle attached to it, which is called double materiality. Double materiality is that first we are seeing the financial materiality, that how climate and environmental factors affect the bank. Impact materiality, how is the bank lending increasing the emission, right? So this is what, which means that how is the bank's lending investment activity affect climate and society. So this could be like climate first, then bank risk, then bank finance, and climate outcome. For example, bank exposure to coal based power is suppose 15,000 crore. Transition policy that the government has, that they want to phase out the mining, it increases the PD 4 to 7%. So this is called financial materiality. At the same time, financing coal expansion increases national carbon emission. So this is what we say. So financial materiality and impact materiality. For example, bank has given some loan that, okay, you want to, so suppose bank has so government is hell bent on cutting down on the emission, right? At the same time, they are also phasing out coal, but you have given a loan to a coal based or mining firm which is operating in coal, and it is expected to expand at the same time, right? So if the government is reducing the emission, it is also cutting down on mining, but some firms are allowed to operate because they also have to survive. So in that case, the financial materiality will be that how much money has been given to the bank, how much money has been given by the bank to the firm, and whether that money is leading to increase in emission, right? So this is what we call it a double, financial and impact, that how much it has, right? So this is how, and it is linked with that. So suppose flood increases PD in agriculture loans, and here we have the 10,000 crore coal expansion. So this is what here, and it is linked with, as I mentioned, that it is linked with the ESG disclosure and also with the sustainability related finance regulations, and also at the bank level climate stress testing, right? So this is where it is important. So let's have the example. I think this will sort out your understanding, and also it will strengthen your understanding in a big way. So bank exposure to coastal infrastructure is suppose 5,000 crore, right? Cyclone increases the probability default from 3 to 7%. So your expected loss will be 0.07 minus 0.03 given the loss given default into exposure, right? So this is also, so it means that it is certainly going to increase your exposure, right? So 0.04 into 5,000 will be doing. Now impact materiality, bank lends 20,000 crore to coal power projects. If each project emits 1 million ton of CO2 annually, so then you can think about that bank is indirectly increasing the emission by 20 million, and this is where it is very, very important. So it links with the potential regulations, sustainability, and all those rules and regulations are aligned with it. Now it can also be touched upon, like for example, in terms of impact materiality. So how bank financing affect climate outcomes and long-term systematic risk, or you can say systemic risk. So bank lends 20,000 crore to coal power project, right? If each project emits 1 million ton CO2 annually, right? So it means that it is having 20 million ton of CO2, and this further creates the trouble for the others, right? So this is just the extension of the previous slide. One more angle that we touch upon is related to what we call it as the recent developments that we have seen in the case of the banking sector regulation on climate change. So there is something called Network for Greening the Financial System, NGFS. It was established in 2017, and it is the voluntary organization that helps the central banks and financial supervisors to come out with regulations related to the banking. So here we have a NGFS, it is in short form it is called. It was established in 2017, and right now it has 149 members across 92 countries, and 24 observers are also included. If you go on the NGFS website, it is interesting, they have all the documents available, you can go through. What is the objective of this NGFS? That it has to deal with prudential supervision that we saw because of climate shock, how PD, ED and LGD is increasing, and expected loss how we are seeing, and it further impacting the tier 1 capital. Financial stability monitoring, that how it is linked. Then here we have the macro financial risk assessment. So third is the, and fourth is the central bank central bank risk management practices, which means that if one central bank is introducing some new measures, and if there is a good impact of that, then that practice will be shared to all the central banks, and they will try to implement in their jurisdictions. So this is where NGFS recognizes climate risk as physical risk plus transition risk, and this leads to what they call it as the financial risk, and financial risk is further linked with the double materiality that we saw. So it is also a very good organization to look into the climate related angles. So the idea is that they have to develop their standardized climate stress testing scenarios. They have to also work out the climate related data, explore and come out with taxonomies and disclosures, macro financial modeling, how the climate change is going to impact, support alignment with net zero transition pathways. So all these things are linked with this, and NGFS has become a crucial organization, and over a period of time we can see that it is linked with some of the scenarios already dealing with. For example, they are working with the integrated assessment models, that how they can cover the overall economy even at the multi-country level. In case of Europe, it is quite possible. Then carbon price trajectory and policy shock, that what will be the carbon price and how much transition risk and decarbonization can be helpful. Then further the macro aspect, GDP, inflation, all these things are linked. Basically they want to see that how emissions increase leads to carbon price increase, and this may have impact on the macroeconomic variable. So this is what we try to get into. NGFS scenarios are also categorized into 3. This I will also touch upon in the next class, that how we are trying to touch upon. So there are 3 broad categories. One is called orderly transition, then second is called disorderly transition, and third is called hothouse world, which means that orderly transition, transition that government took timely measures, as a result the emission has come down. Disorderly transition, because it has delayed the transition, so suddenly government is coming out with regulations like carbon tax or carbon trading or mandatory emission reductions. So this will further create trouble. And third is the hothouse world, that the government slept throughout and suddenly it has come out with regulations, and those regulations are impacting, which means that macro shock, this will create further poverty default, loss given default and exposure at default quite considerably. So with this I am going to stop. I hope this session was okay to all of you, and it gave you enough idea about the emerging fields in the banking domain, which is the climate finance related banking sector regulation. And in the next session we will be having further understanding about the NGFS, and then we will move to the further topics. And those of you who want to explore further, just search on internet about these topics and you will be happy to find them. So with this, I am stopping it here. Thank you so much, and I really appreciate your attention.